Traders attempting to scalp this weekend's price action are being ruthlessly wiped out by volatile, unpredictable market manipulation. Retail traders are losing capital right now because they are treating micro 4-hour range breakouts as if they were major macro market movements. To understand why this happens, we have to recognize the institutional reality that markets are not moving randomly. They are mathematically drawn to clusters of leveraged capital to find the liquidity needed to execute large orders. We are currently mapping a specific high-density target for these algorithms, a $3.5 million liquidity pool resting at $68,000. Identifying this gravitational pull is the only way to avoid becoming institutional exit liquidity during periods of weekend market indecision. The primary analytical error currently blinding the crypto market is a misunderstanding of how short-term data interacts with long-term trends. Traders are mistakenly identifying a localized 3-day oversold bounce as a full reversal of the macro bearish trend. This chart compares the mid-2022 3-day Bitcoin RSI structure on the left with our current structure on the right. The RSI, or Relative Strength Index, is a momentum oscillator that measures the speed and change of price movements to identify overbought or oversold conditions. While the short term looks oversold, the macro weekly timeframe is still playing out a massive bearish divergence. This occurs when the price maintains its level while momentum indicators continue to drop, signaling hidden weakness in the trend. In the mid-2022 example on the left, an identical oversold RSI signal produced a 30-day relief rally. It was a temporary break in the downtrend before the price collapsed to new lows. Applying that historical data to the present moment, we are currently operating inside that same deceptive 3-day relief window. The upward move is a characteristic of the larger bear market, not an exit from it. Adding to the risk is a massive macro resistance block sitting overhead between $72,000 and $76,000, which acts as a ceiling for this bounce. If traditional markets open red on Monday, a sudden injection of bearish volume could instantly terminate this relief structure. Until the macro $76,000 resistance breaks, any upward momentum is a temporary trap within a larger downtrend. To see what happens next, we have to look at the immediate 4-hour time frame to diagnose the current market paralysis. With traditional equities markets closed for the weekend, Bitcoin is trapped, swinging rigidly back and forth between two defined technical boundaries. The parameters are narrow. Strong support sits between $69,000 and $69,500, while resistance is capped at $71,000 to $72,000. Market makers use this sideways chop to build massive pools of leveraged liquidity outside these boundaries, waiting for a catalyst to trigger the stop losses. This heat map reveals the specific data hiding beneath the price action. There is a high-density concentration of capital between $68,000 and $68,700. Recent price action shows this pattern in effect. The market swept the bullish liquidity above the price before dumping to clear out the $69,000 level. The newly formed $3.5 million liquidity pool at $68,000 is now the highest probability target for the next major move. Expect continued sideways movement through Sunday, followed by a targeted downside sweep early next week as the new trading week begins. Because price action is drawn towards these dense liquidity clusters, the move to $68,000 is a calculated execution by market algorithms. This dynamic leads to a state where altcoins are entirely subjugated. Perfectly structured technical setups on these assets are failing because they lack independent momentum. This chart shows Bitcoin market dominance flatlining. Bitcoin dominance is the ratio of Bitcoin's market cap to the rest of the crypto market. When it stays flat like this, assets like ETH, Sol, and Link are bound to Bitcoin's gravity and mirror its path exactly. Ethereum's current position reflects this stagnation, with short-term resistance holding firm between 2150 and 2250. Ethereum remains bearish on the macro trend until it can secure a high-volume weekly close above 2400. Solana is also facing a critical rejection, struggling precisely at the macro resistance box spanning $95 to $105. For Chainlink, the psychological $10 level is acting as a ceiling that the asset cannot break under current market conditions. None of these altcoins are likely to break their resistance levels until Bitcoin executes its $68,000 liquidity sweep. Trading these high beta sweeps requires an institutional-grade platform. This is why Crypto Whale Radar relies on BingX for precise execution. Using the link in the description provides access to exclusive bonuses and the direct mentorship needed to navigate these specific market sweeps. Analyzing altcoins in isolation right now is a mistake. They are currently trading as leveraged derivatives of Bitcoin's impending $68,000 hunt. The golden rule for this environment is to preserve capital and avoid trading the low-volume weekend chop. This matrix summarizes the exact pivot levels to monitor for the week ahead. Every major asset is currently pinned against resistance with a downward bias. Keep your capital sidelined until the algorithms sweep the $68,000 to $68,700 liquidity zone. Hunting these high-probability market setups alongside massive institutional trading systems requires immense patience, strict discipline, and technical precision. Subscribing to Crypto Whale Radar ensures you receive the data updates needed to track these institutional setups as they develop. However, knowing the $68,000 target is useless if poor risk management results in liquidation before the market reaches that level. Click the video on your screen right now to learn the position sizing mathematics used by profitable whales to stay in the trade.